Let's say you and your friend both invest $200 a month. Same timeline, same fund, same discipline. But when retirement hits, one retires with $227,000. The other, over $1.2 million and $11,000 a month in income. What made the difference? Just one overlooked decision, and most investors have no idea they're messing it up. In this video, I'll walk you and Josh through exactly what that mistake is and how to fix it. I will explain SCHD, what it is, how it works, and why it's one of the most powerful ETFs for building steady, growing income. I'll also compare it to the other popular funds in the same category, like VIG, DGRO, and VYM, so you can see exactly where SCHD stands out. I'll even break down exactly how much a $100,000 investment in SCHD back in 2014 would be worth today, dividends and all. And in the end, I'll show you how to turn a $200 monthly investment into a portfolio worth over $1 million, which generates over $11,000 in monthly income. Plus, what to do if you want to retire just 12 years from now. To understand how or why this works, we need to start at the beginning. So what is SCHD anyway? It stands for Schwab US Dividend Equity ETF. Kind of a mouthful, but don't let that scare you off. Launched back in 2011 by Charles Schwab, it's basically a super simple way to invest in a bunch of solid American companies that do one really important thing: pay reliable, growing dividends. And when I say simple, I mean it. SCHD isn't about chasing hype or trying to outsmart the market. It's built on rules. Clear, smart rules that make sure only financially strong companies make the cut. To even get a shot at being included in SCHD, a company has to check a few big boxes. It must have been paying dividends for at least 10 years, be worth over $500 million, and have enough trading volume to keep things smooth for investors. That alone weeds out a ton of riskier flash-in-the-pan names. Then it gets ranked across 4 key areas: how much cash it generates compared to its debt, how efficiently it uses investors' money, that's return on equity, how strong its current dividend yield is, and how fast it's grown those payouts over the past 5 years. Only the top 100 companies that crush it across all those metrics make it in. And to keep things balanced, SCHD doesn't let any single company take up more than 4 to 5% of the fund, and no one sector can hog more than 25%. And remember, this fund doesn't just say it tracks those companies, it actually owns them. That's called full replication. So when you invest in SCHD, you're truly getting a slice of all those high-quality businesses. And once a year, the whole list gets refreshed. If a company slips, it's out. But SCHD isn't just about collecting dividends, it's about growing them. That's a big deal because growing dividends can turn a nice income stream into a really powerful snowball over time. And because it's spread out across different sectors, like energy, healthcare, tech, and consumer goods, it's got a nice balance that helps ride out the ups and downs of the market. Plus, it's cheap to own. The fees are super low, so more of your money stays where it belongs, working for you. Now that you know what it is, let's stack it up against some of the other big-name ETFs out there and see how it really performs. ETF Showdown: SCHD versus VIG versus DGRO versus VYM. I'm talking about a real showdown here. SCHD versus VIG, DGRO, and VYM. All of them are popular. All of them aim to deliver dividend income, but they each go about it a little differently. So let's start with the recent returns. Over the past year, SCHD didn't have its best showing. It was slightly in the red, around negative 0.3%. Meanwhile, VIG pulled in over 8%, DGRO delivered 7.5%, and VYM landed just over 7.6%. Not exactly a win for SCHD. Zoom out to 3 years and the trend holds. VIG holds with more than 36% growth, followed by DGRO at 28%, VYM at almost 23%, and SCHD trailing at just over 6%. Stretch it to 5 years, and SCHD starts to catch up a bit with 55%, but VIG, DGRO, and VYM still pull ahead. And over a full decade, SCHD has nearly doubled in value, 97%, but again VIG and DGRO beat it with only VYM lagging slightly behind. So yes, compared to its peers, SCHD has underperformed in recent years. That's largely due to its sector allocation. SCHD leans heavily toward value stocks and avoids mega-cap tech names, the Apples and Nvidias of the world, which have fueled much of the recent market rally. By contrast, ETFs like VIG and DGRO have more exposure to growth-oriented holdings, which helps explain their stronger performance. But SCHD was never built to be the fastest. It was designed for one thing above all: income stability. And when you look at the dividend metrics across the board, that purpose becomes crystal clear. Among the four, SCHD currently offers the highest dividend yield of the group, nearly 4%. Compare that to VIG at under 2%, DGRO at a little over 2%, and VYM at just under 3%. That's already a strong edge for income seekers, but high yield is just one part of the puzzle. What really makes a difference over time is how fast those dividends grow. Over the last 3 years, SCHD's dividend has increased at a rate of 11.26% per year. That's ahead of VIG, VYM, and DGRO's. Over 5 years, SCHD's pace picks up even more at 11.44% annually, right there with VIG and again ahead of the rest. And when you stretch that view out over 10 years, SCHD holds steady with a long-term growth rate of 11.3%. Only DGRO edges it out slightly with 12.53%, while VIG and VYM land much lower. And here's another sign of stability: consistency. SCHD has increased its dividend every single year for 13 years. VYM leads the pack with 14, VIG follows at 11, and DGRO's been doing it for a solid 10 years. They all pay quarterly, so you're getting regular, reliable income no matter which one you choose. So yes, SCHD may not post the flashiest returns on paper, but when you look at the full picture, yield plus growth plus track record, SCHD is incredibly well balanced and more consistent. And in today's environment, that kind of stability isn't just nice, it's absolutely necessary. Why SCHD matters even more in today's economy. Let's not sugarcoat it. Today's economy is confusing. Inflation might be cooling slightly, but it's still high enough to eat into your savings. Interest rates are still high. And the market? It's been whiplashing between recovery hopes and recession fears every other week. And many investors are asking the same question: where can I put my money that actually feels safe but still grows? This is exactly where SCHD stands out. Unlike growth-focused ETFs that load up on flashy tech stocks, SCHD leans into value. It's concentrated in sectors like energy, healthcare, consumer staples, and industrials. Industries that actually tend to hold up when rates are high and markets are jumpy. And here's the key: those companies don't just survive tough markets, they keep paying. SCHD's top holdings like Coca-Cola, Verizon, Lockheed Martin, and AbbVie have one thing in common: long histories of paying dividends through thick and thin. Even during COVID, these companies kept rewarding investors while many others cut back. Many growth stocks struggle in high interest rate environments, but dividend-paying value stocks tend to hold up better. Investors flock to them for stability and cash flow, both of which SCHD delivers. Inside SCHD, top holdings and sector exposure. Now, let's see what's actually inside SCHD, because understanding the companies you're investing in gives you a whole new level of confidence. SCHD holds 103 companies right now, but here's where it gets interesting. Over 40% of the fund is concentrated in just its top 10 holdings. That might sound like a lot, but when you look at the actual names, it makes a lot of sense. At the top of the list is ConocoPhillips with 4.4%, one of the biggest energy players in the US. Then you've got Coca-Cola at 4.38%. Yeah, that Coca-Cola, a brand that's been around for over a century. Verizon is right there too, bringing telecom stability, and Lockheed Martin adds defense exposure, a sector that tends to stay strong no matter what's going on politically or economically. You'll also see Home Depot, AbbVie, Cisco Systems, Chevron, and Amgen in the mix. Companies from sectors like healthcare, energy, retail, and tech, all with long track records of steady profits and reliable dividend payouts. Each one plays a vital role in keeping SCHD's income stream steady, regardless of what the broader market is doing. Sector-wise, SCHD is weighted most heavily toward consumer defensive stocks, which make up 19.75% of the portfolio. Energy is close behind at 19.23%, followed by healthcare at 15.25%, industrials at 11.11%, and technology at 9.87%. It's a well-rounded blend, but what makes it powerful is that it leans into essential industries, the stuff people still need, even during a recession. This combination, heavy on reliable sectors and light on volatility, gives SCHD a defensive core. It's focused on companies that deliver essentials: food, energy, medicine, communication, and infrastructure, and it prioritizes those that generate consistent earnings and return capital through growing dividends. Now, numbers don't lie, and when it comes to SCHD, they tell a story of strength, consistency, and long-term income growth. It's not the flashiest ETF on the market, but it does what most investors hope for. It builds wealth and pays you along the way. Next, I will show you how much you would have earned if you had invested $100,000 in 2014. And in the end, I'll show you how to turn a $200 monthly investment into a portfolio worth over $1 million, plus what to do if you want to retire just 12 years from now. SCHD, then versus now. Alright, so we've talked about SCHD's income and stability, but what if you had actually put your money into it a while ago? How would that have played out? Let's rewind to 2014. If you'd invested $100,000 into SCHD back then and just let it ride, no timing the market, no jumping in and out, no picking stocks, by 2025, that investment would have grown to about $272,356. That's almost 3 times your money in 10 years. This growth translates into an 11.33% annualized return, or CAGR, which is a strong showing for a dividend-focused ETF. SCHD did all this with a volatility level, that's standard deviation if we're being technical, of just 15.15%. That means it had some ups and downs, sure, but nothing wild compared to what you'd see with riskier funds. Its worst year? Down 5.56%, and the biggest dip from its peak, the maximum drawdown, was 21.54%. That's pretty manageable when you consider the chaos we've seen over the past decade. And if we look at the journey chart itself, there are some standout moments. From 2016 to 2019, SCHD steadily grew upward as the economy was strong and the market kept rising. Then came the COVID crash in early 2020, and yes, SCHD dropped, just like everything else. But what's impressive is how quickly it bounced back. By late 2020, it was steadily climbing again, and it kept that momentum going through 2021. Starting in 2022, things got choppy. Inflation kicked in, the Fed started raising rates, and the market got shaky. That kind of environment tends to hit dividend and value stocks a bit harder than high-growth tech, so SCHD had some bumps. But even then, it held its ground. In fact, it hit new highs by early 2024 before a mild dip in 2025, likely just the market adjusting, as it does. But the bigger picture is clear. SCHD weathered global pandemics, inflation shocks, and interest rate spikes, and still turned a 6-figure investment into nearly $275,000. That's the power of consistency, dividend strength, and quality holdings. The $1 million mistake most investors make. Now here's a mistake a lot of people make, and it seems harmless at first. They start investing. They pick a solid fund, they get those sweet dividend payments every quarter, and then they take the cash and spend it. Maybe it goes to groceries, maybe it covers a bill, or maybe it just sits in a checking account. It feels good in the moment, like, hey, my investments are paying me. But here's the problem. By not reinvesting those dividends, they're leaving hundreds of thousands, even millions on the table over time. Because when you skip reinvestment, you're basically hitting pause on your portfolio's growth. You're choosing short-term comfort over long-term compounding, and the difference that makes? It's massive. Now, let me show you what happens when you take the exact same $200 a month and just make one small change. Let's walk through what retirement could look like with SCHD, both with and without the Dividend Reinvestment Plan, or DRIP for short. Retirement projections with and without DRIP. Let's start with the no DRIP path, where you and Josh invest in SCHD, but instead of reinvesting your dividends, you just take the cash every time it rolls in. No compounding, no extra shares, just steady income in your pocket while your original investments keep doing their thing. So here's how that plays out. You're putting in $200 a month, which adds up to $2,400 a year. Simple. After 1 year, your portfolio's worth, you guessed it, $2,400. But fast forward a decade, and that small consistent habit has turned into a $33,000 portfolio. Keep going to year 20, and now you would be sitting at around $98,000. And if you stay the course for the full 30 years, you end up with a portfolio worth $227,000 just from showing up every month and sticking to the plan. By year 30, that no-drip strategy will be paying you about $28,000 a year in dividends. That's just under $2,400 a month, all without touching your original investment. It's consistent, it's predictable, and it works. But now let's ask the big question. What if, instead of taking those dividends as cash, you reinvested every one of them back into SCHD? That's where the story takes a sharp turn and the magic of compounding really kicks in. Let's walk through that next. Now let's hit rewind and take a different approach, the drip route. This time, every single dividend is reinvested. Instead of taking the cash, you let it buy more SCHD shares. Then those shares generate more dividends, which buy even more shares. And before long, you've got a snowball that's growing faster and faster on its own. Just like before, year 1 looks pretty much the same. You put in $2,400, and that's what your portfolio is worth. But by year 10, your portfolio will be worth around $42,000. By year 20, your portfolio will grow to about $211,000. And then year 30 rolls around. That little $200 a month habit, thanks to drip, will turn into a portfolio worth $1.19 million. That $1 million portfolio will be generating $133,000 a year in dividend income. That's over $11,000 a month, all without selling a single share. Now, compare that to the no-drip path. You still did great. That portfolio pays $28,000 a year, and that's nothing to shrug at. But the reinvested route, it quadruples that income. Same fund, same contributions. The only difference? You put your dividends to work instead of taking them out. And when you zoom in on how that growth actually happens, it tells a story that's hard to ignore. In the early years, both strategies move slowly and pretty evenly. By year 10, they're both generating about $2,000 in annual dividends. But then the gap starts to open. From years 10 to 20, the drip portfolio begins pulling away fast. By year 20, it's making $16,000 a year in dividends, twice what the non-drip version pays. And then the snowball gets serious. By year 30, the no-drip strategy is paying that solid $28,000 per year. But drip? You're looking at $133,000 annually. That's life-changing income, all from sticking to the plan and reinvesting every step of the way. And not to mention the $800,000 difference in portfolio valuation. Shifting from 30 to 12-year goal. So up to this point, we've been looking at what happens over 30 years, the full long game, and the results are incredible, no doubt about it. But let's be honest, not everyone has 3 decades to let their portfolio simmer. Maybe you're getting a later start. Maybe you're aiming for a more flexible kind of retirement, something that happens in 10 to 15 years, not 30. That's a totally different game, and it calls for a different approach. Instead of relying on small monthly contributions alone, this new plan starts with a solid base, a one-time investment of $100,000. Maybe it's a rollover from a 401k or savings, and then keeps growing with regular contributions of $1,000 a month. It's more aggressive than the $200 a month strategy, but that's what shortens the timeline. You're compressing what would normally take decades into just over a decade. And the income goal? We're shifting from building massive long-term wealth to creating real monthly cash flow you can actually use within the next 10 to 15 years. Let's say $3,000 a month. Let's walk through what this accelerated version looks like and how quickly it can start to change your life. Hitting the target in 12 years. In year 1, your portfolio will grow to $123,000 and you will be pulling in about $3,990 a year in dividends. By year 3, your dividend income climbs to around $6,500 and your total portfolio value reaches about $177,000. Fast forward to year 6 and you would be earning about $12,000 a year. That's $1,000 a month in passive income. Enough to cover major bills or even fund a part-time lifestyle. Your portfolio? It will be sitting at $287,000. By year 9, your investment will be valued at $447,000, paying around $22,000 in yearly dividend income, or about $1,800 in monthly dividend income. Good, but still not the $3,000 per month target. Give it 3 more years, and by the 12th year mark, your investment will be valued at $687,000, paying around $38,000 in annual dividend income, which equates to over $3,000 in monthly dividend income. Now that you've seen how different strategies play out over time, you might be asking the big question, which one's actually better? And the honest answer is, it depends on where you are in life and what you need your money to do for you. If you're in your 60s or 70s and you're looking to live off your investments today, then taking dividends as cash, the no drip route, makes a ton of sense. You get stable, regular income without having to sell shares or worry about market dips. You've built the portfolio, now it's paying you back. That's retirement the way it's meant to be. Simple, stress-free, and built on a foundation of income. But if you're younger, maybe in your 20s, 30s, or 40s, and you've still got time on your side, reinvesting your dividends can completely reshape your future. It's not just about growing your portfolio, it's about setting yourself up for financial freedom, early retirement, or even building wealth that lasts for generations. And the best part is, you don't have to pick one and stick with it forever. You can start with drip, let that snowball grow, and then flip the switch when you're ready. Start collecting income when the time is right. That's the kind of flexibility SCHD gives you. It's designed for both growth and income, depending on what you need and when. All three paths work. They're just different roads to the same destination: financial independence. Want to start getting paid as soon as next week? Click the video on screen to see how a carefully selected 12-stock portfolio can pay you every single week.